In October, wage gains hit a 9-year high, but consumers think things are about to get even better. Which brings us to our chart of the day. Miles.
All right, well, as we see here, this is annual wage growth expectations for folks that are considered of working age by economists. So that would be people ages 25 to 54. This comes from the University of Michigan Consumer Sentiment Survey released Friday. We see here that expectations for wage gains next year, 3.6%. That is the highest we've seen since February of 2005. So at roughly a 13.5-year high for this number. Overall, points to better times ahead for consumers. Now, these wage gains may not come to pass, but we did see 3.1% average hourly earnings growth across all levels of employment in October. Economists expect that we are now looking north of 3% average hourly earnings growth going forward, and I think this suggests that consumers believe that will come to pass. And so this, of course, all points to a better picture for the consumer, more money in your pocket, more money to spend.
Does it also point to tightening margins for companies? Is it bad for corporate America?
Well, it depends how these costs are passed through. I think a lot of times people view wage pressures as something that will first hit margins of companies, but we've seen a number of companies on conference calls suggest that they think they can pass higher costs on to consumers. That would be inflationary overall. We'll get the inflation numbers for October next Wednesday, I believe. And I think all of this paints to a picture of, we know that margins are likely to come down a little bit. They are basically at record highs. We have earnings up 25% year over year. The picture for corporates going to be hard to get a lot better. How much that impacts the inflation picture, and then, of course, how aggressively the Fed would want to work against any uptick in inflation, any sustained rise in wages, would be the real question for markets.
You know, Miles, look at this chart, and I think I'm getting 40 gifts for Christmas because my parents are probably rolling in it. But really, seriously, with
you still get presents from your
damn right,
parents?
Presents. But listen, you know what I see this too? Income is going up, but the savings rate, U.S. savings rate, is still about 6.5% in this country. What do you think about that?
Well, I think what's interesting about the savings rate is, and we've mentioned it a couple times this week, that was actually revised significantly earlier this year. So the savings rate had been down to about 3% or so, but we saw a massive revision in the way that the BLS was calculating that, or I think the BEA does that number. So the way that they were calculating that number, and we had a huge bump in the savings rate. Usually we would see the savings rate bottom out around that 3% level during expansion. So I think that indicates consumers could get more aggressive. We continue to see things like mortgage debt as a percent of overall household net worth very low. We see credit card debt creeping up a little bit, but still pretty low. I think student loan debt is a big overhang on the consumers, particularly as millennials work into their peak consumption years. But overall, people are going to be more pessimistic than I think employers are going to be in how far wages are going to go, right? Employers never want wages to go up, so they'll always kind of say, yeah, we're a little bit worried about it. Consumers, especially after the crisis, kind of think, I'm about to get fired. I'm never going to get a raise.
Right.
And now that we're seeing that psychology change, I think it's a big change for the
Jen, how about you? But I would see this chart, and if I'm at the Federal Reserve, I kind of freak out a little bit. We got to pick up these rate increases.
Faster, 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 faster. Let's go. But I don't know. There's so much other stuff going on that maybe they don't. No one's buying homes with this extra money.
Well, not yet. Right? Or until we have more housing supply and homes get a little bit cheaper. But I do think, to your point, Brian, the Fed is going to look at the inflation number. It's right at target right now. They say it's symmetric, but I think it's pretty clear the Fed wants to push back against any inflation over 2%. And I do think the Fed looks at this number and says, we might be overheating in the labor market. And what the Fed really wants to avoid is that. I think that's why they've been so insistent on quarterly rate hikes. And will probably be that way for the next year or so.
All right, Miles, chart of the day.